My name is Alan Gold, and I'm going to be your host for today's webinar, the first in our Global Crisis series called Coping with the Cotton Crisis of 2011. Thanks very much for being with us on this event. And I should say, given the global coverage that we have, good afternoon, good evening, and good morning to everyone who is joining us. And thanks for being here. There's quite a large number of you. So I want to go through a few points of logistics. The audio is muted so that you can hear us, but we won't be able to hear your comments. Instead, we'd like to ask you on your right-hand side of your screen, you should see a questions box. Feel free to type into that box any questions that you have for me or, much more importantly, for Mr. Hastings when he does his segment of the webinar. And we'll do our best to record them and discuss them at the very end of the session. I also want to let you know that we'll be extending our Q&A period a bit today because this is such an important topic and there are so many folks on the call today. But still, if we don't get to your questions, we'll be happy to answer them one-on-one following the event. I also want to let you know that we have plans to provide a recorded copy of this webinar. It will be available in a few days. We'll provide details to all attendees as to where they can reach the file for downloading. So thanks again for being here. I also want to tell you about two upcoming webinars that we have that may also be of interest to you. The first is on November 30th at 11 a.m., same time as this event. And we're going to be talking about the global labor market and posing the question, is this a crisis in the making? And if you're concerned about global resources, if you're concerned about factory capacity, I think you'll find this a very interesting and compelling event. And then on December 9th, we'll be taking a left-hand turn into the very important topics of social media and mobility as it relates to retailers and how they are applying the techniques of social media and how they're working with mobile applications to grow their cross-channel business. And for those of you who are brand manufacturers or suppliers on the call, you'll find that interesting as well to understand the trends that that your customers are employing. So today, as we talk about the cotton crisis of 2011, we're going to first do a very brief introduction about TradeStone because I see many of you on this call may not be as familiar with us as others. But then really dive into the meat of the presentation with Richard Hastings as he talks about his perspectives on the crisis and its issues and its causes and even potentially what the future holds. Then the next section, be coming back and speaking briefly about the practical impact and some of the considerations that you may, as retailers and suppliers and manufacturers, want to keep in mind, and how technology may facilitate that. And then we'll have, as I say, an open question and answer session. Once again, please type your questions into the right-hand corner question box, and we'll remind you about how to do that again when we get to the end. So, very quickly, by way of introduction, who is TradeStone? Our customers certainly know, but for those of you who are unfamiliar, we enable retailers and their suppliers to unify the entire design-to-delivery process, both domestic and global activities, as well as private label and global brands. So in one environment, we're enabling something that we call merchandise lifecycle management. And it's a term that we introduced to the market as a holistic approach to design to delivery. And it's been gaining adoption in the market with analysts and the press, and much more importantly, with our set of global customers. We are, unlike many other providers in this space, 100% focused on retailers and manufacturers. Our management team largely comes from the retail market space and the brand manufacturing space. We are a leader in both thought and in terms of performance, we co-founded an arts, that's a technology standard setting group that many of you know, 4PLM, and we have also put offices around the globe to service our large customer base. We're very proud of the customers that we have globally. We have global brands, global customers, and we have a number of customers, all of whom are leaders in their respective geographies and/or vertical markets. Now, in preparing for this webinar series, it really got its genesis out of both our own research into the market, discussions with our customers, and then most recently, input from a number of research firms, in particular RSR Research, where it seemed as we looked at all of these data points converging, that it seemed to all of us that really some of the critical concerns that all of you have tend to revolve around the issues of uncertainty and risk. And while that sounds self-evident, it's not always so, as we tend to get concentrated on very practical, pragmatic, and day-to-day tactical activities. But if we boil down the things that I think are common threads across all of our research as well as market research, I think it's going to wind up impacting on you as having the same sort of familiarity and of concern. One is finding and keeping partners. Another is coping with a deeply extended supply chain. A third is managing what is by definition an inhibited reaction time, an extended amount of time to be able to react to issues and changes. Inability to be flexible enough to deal quickly with the unexpected. I mean, all of those speak to risk and the need to mitigate that risk. And so as we sat down and looked at global issues, what became very clear to us is that all of the news about what's happening in the raw materials world in general, and in particular the situation with cotton, is a particularly important one. And judging by the record number of people we have on this call, we think that we've caught that wave fairly quickly. So with that, I'd like to stop my preamble and introduce you to our guest speaker today, Richard Hastings. He is a consumer strategist at investment bank Global Hunter Securities, where he provides top-line views of major trends in the consumer universe. Retailing, he looks at capital markets, foreign exchange, employment trends, real estate, construction, marketing, advertising, social media, and probably he's a world-class cook as well. In particular, he's been looking at cotton since, if I recall correctly, about 1997. He's a frequent guest on CNBC and is very frequently a keynote speaker at major industry events. In fact, I think he's speaking to us from a site where he'll be talking to a very large group later today. So with that, I'm going to transition over to Richard and welcome you to our webinar. And technology withstanding, there we are. Richard, all yours.
Thank you, Alan. Alan, let's make sure that everything looks the way it's supposed to. Are you able to see the screen of the slideshow correctly?
Yes, it's fine. Thank you.
Okay, then let's proceed. The basis for the conversation regarding cotton goes back approximately 2 years ago, and I do have to give some thanks to Mr. John Flanagan of Flanagan Trading Corporation in North Carolina, who has provided consistent feedback regarding my questions about what might be happening in the cotton market. And we suspected in our conversation that the prices for cotton would not come out correctly when the global economy rebounded after the collapse of late 2008. This was based partially on simple supply and demand and based on changing plantings and the amount of acreage globally dedicated to other types of crops especially for biofuels such as corn. And we'll see a little bit of that as we proceed in the presentation. So the current situation has been understood as a risk that might occur going back a couple of years. We did not suspect that it would be quite this inflationary, so the move in cotton starting a few months ago is spectacular by any historical comparisons. The mechanics of what makes the cotton market go through this unusual inflationary cycle is based on what you see right there. Population growth, product demand, a lot of geopolitical deal-making and subsidies, monetary forces, and climate disturbances, which of course is related to all of the above. As we change what we do on the planet, we do have a little bit of an influence on climate, and that in turn, the slightest little change in climate has a massive impact on the amount of crop production, and we will go through some of the latest information regarding climate disturbances regarding crop yields. All of that goes into the supply and demand part of the story, which explains why cotton prices are at this time so high. Proceeding right along, let's get a quick look at the latest trends in the cotton prices based on monthly prices. So the candlestick chart that we see right here takes us back to January of 2008, before the crisis began, when prices for cotton per pound, actually, if you look on the left-hand side, that would not be $100. I apologize for that. That would be 100 cents. So what we're looking at is a typo on the left-hand axis, and that should be 80 cents or 100 cents or 120, 140, and 160 cents. Looking at it based on that, the normal prices before the crisis and the collapse would have been somewhere around 85 cents per pound. Then we had an enormous collapse in prices, and gradually cotton began to resume a more normal course. Then suddenly, in about August of 2010, and these prices are based on the December 2010 exchange-traded contract, starting in about August 2010, prices began to climb way out of proportion to where they were during the crisis and the recovery after the collapse of 2008. We have noticed that most of the indicators that we would look at bottomed out right around August 22nd. So the change in the momentum in cotton prices is interesting in that it is consistent with our measurement that August 2010 was the bottom for the global economy, and that the true recovery has only begun very recently. The recent events over in Europe regarding the Irish banking system is just a bump in the road, and that'll be resolved along the way. The Europeans will figure out how to fund the banking system over there, similar to what we're doing over here in the Federal Reserve's action regarding quantitative easing and purchasing federal issuances of Treasury debt. You can see very simply that the prices have exploded way out of proportion to where they were, and yet there is a little bit of a reversal after China announced that they would tighten up a variety of different things starting at November 10th. And that's that candlestick over there on the far right, where the blue part of the candlestick is at the bottom of the candlestick. That indicates that you're getting a little bit of a reversal in the price momentum. Moving right along, in order to understand what's happening in the supply and demand part of the story, we have to look at China, India, the United States, and the other majors, and to take a look at production and consumption, and let's take a look at that right now. China comes out in terms of production, obviously at the top, looking at the cotton seasons, which are measured in terms of the paired years, or 2006, 2007, with August being typically the conclusion of the season. Going over here, we can see that from 2006 until the estimates for the 2010 current season, we're down about 15%. So where is the production increasing and decreasing? India. India is becoming a bigger geopolitical force in cotton. They have not had the kind of climate disturbance that occurred recently over in Pakistan. And India is very, very upset about what's going on in exports of a key crop to China, And very recently, a lot of workers in India are beginning to protest significantly about what's going on with India's exports of finished fibers of cotton or raw cotton. In other words, the workers in India, they don't want to export really much of anything. They want to protect their jobs, and they want to protect their industry, and a protectionist move is underway in India's role in the world cotton market. This is a very big development. Look at the size of their production. Look at the scale of their business in the global cotton market, and you can see that any geopolitical type of impact coming from India's ability to export supply into the market is a constraint on supply and is therefore inflationary. Looking at the United States, over the last approximately 5 years, our production is down a little bit. The other biggie that's interesting to take a look at is Brazil. Now, Brazil has had a significant dispute through the World Trade Organization, the WTO, against the United States for our subsidies of cotton crops, and they have been successful in their WTO dispute, which takes many years for that thing to take place. And in 2009, the WTO decision was conclusive that Brazil did have merits for what they said, and we send them about $147 million a year in order to help Brazil not pursue any other remedies. And we'll take a look at some of the subsidies and discuss that as well. So taking a look at the table in front of us right here, we can see that the impact of the current crisis in India is very influential on preventing prices from declining much further. Very likely, we can get a little bit of a break occasionally in cotton prices, but the latest activity in India suggests that prices would continue to go up based on supply and demand because of the supply constraints resulting from the India political activity. Moving to the consumption and use part of the story, we can see over here on this table that China, as a percentage of the total of domestic consumption, has been pretty steady at about 40% of the grand total. The United States comes in much, much lower. Obviously, the population is, of course, much lower, and the manufacturing, of course, is much lower. We are a major exporter of cotton, and China is the primary destination. It's very geopolitical and involves a lot of very sensitive geopolitical issues. Taking a look at the stocks-to-use ratio all the way at the bottom, and that's where I'd like for you to make sure you're taking a look right now. As that number goes down, prices go up. So when you go from about 50% all the way up to the 55% when the crisis occurred, and then you rapidly start to go down towards about 36%, that is a problem for prices. So the lower the number on the stocks-to-use ratio, typically speaking, the higher the price. It's that simple. Moving to the next table over here, we can see from additional USDA reports, the amount of acres planted with biofuels have significantly influenced the domestic proportions of biofuels to cotton, and that has contributed to the current inflation wave in cotton. We have a significant amount of interest in producing a lot of corn. Corn as a commodity crop is exported in its raw form, and then it is also converted into a biofuel, and it is exported as a biofuel. It's a major geopolitical crop, and it is subsidized very significantly here in the United States. So at the same time, we export major crops, especially corn and soybeans and cotton, to Asia in order to build various byproducts at lower cost. So part of the objective here in the United States is to produce these crops in very large volume, to export them, to subsidize them so that other countries at very low unit costs of labor can produce different kinds of byproducts to export back to the United States and to other countries. So the story about cotton inflation is terribly geopolitical in nature. Monetary imbalances create other inflationary issues overseas despite the high volume of subsidized exports of key commodities. So the monetary issues and the monetary imbalances also contribute to the inflation story. Now, moving over here, we have to also take a look at what is the relationship between cotton prices and apparel prices, generally speaking. So over here, we're taking a derived look at apparel prices based on the United States Consumer Price Index for apparel, the not seasonally adjusted version. Typically speaking, I try to stay away from seasonal adjustments and try to stick with not seasonally adjusted and then run derived trends from that. Looking at this, the green line is the year-over-year percentage change. You can see on the far right that recently it has been deflationary. A lot of that, of course, is influenced by the massive amount of volume in apparel that takes place through what's called the moderate market. And the moderate market would be the types of apparel that you will see in Walmart, Target, Kohl's to a significant degree, although not completely, although Kohl's, generally speaking, should be classified as a moderate market player. But the amount of volume, generally speaking, that takes place in apparel in the United States through the moderate market pulls the price level down for the entire industry. And that's why these CPIs for apparel, excluding footwear, is coming out at a deflationary trend. Then you get the blue line is the 13-month moving average of the year-over-year percentage change. So you've got a first derivative and a second derivative in order to pick up the true nature of the trend. You do not want to have a period of time when apparel prices, generally speaking, are deflationary and an input cost such as the raw material cotton is quite inflationary. That is a bad situation, and that is why we're having the conversation today. So moving right along, foreign currency exchange plays a major role in all of these things. So I'm going to read through the following bullet points. Most commodities globally are settled in U.S. dollars. The U.S. dollar, you know, for whatever reasons we may want to think, still the reserve currency of the planet. The steady decline in the United States dollar and the USD against major currencies has contributed to higher costs to purchase various commodities. So as the U.S. dollar goes down, it costs more to purchase other commodities. So if you take a look at gold prices, for example, as the dollar goes down, relatively speaking, against major other currencies, the price of gold in U.S. dollars will go up. Similar in crude oil. Adjusting the U.S. dollar to another currency to show the cost of buying another currency, another stronger currency, it reveals the forex side of cotton inflation. Now, inversely, firms may try to sell U.S. dollars to buy a stronger currency, which increases in value against the dollar over time in order to pay less for cotton in dollars. So there's a lot of foreign currency aspects to trying to control inflation globally. The connection between forex, foreign currency exchange, and commodity inflation is very tight and is very tightly interwoven. Quantitative easing in the United States, QE2, contributes to further weakness in the dollar against certain major currencies, and especially against the Swiss franc and the Japanese yen. The combination of dollar weakness, supply and demand disequilibrium, and the volume of production in China and the political subsidies and protections, they all come together to contribute to cotton inflation. So unfortunately, the situation, the way it is right now, because of the monetary problems, because of QE2 in the United States, all of it comes together to create the basis for cotton prices to unfortunately remain relatively higher than we would like. Let's take a look over here, and we can understand if we make an adjustment on cotton prices from the U.S. dollar to the euro, here's where you really start to do something to pick up the real impact of the inflation based on foreign currency problems. So if I adjust my U.S. dollar and I convert it into something based on the euro, then I can take a look at just how much inflation I'm really getting by making that adjustment. So starting off with a percentage change from November of 2007, before the crisis began, and when basically the global economy began to top out, things began to decline after that, and the dollar weakened significantly and the euro strengthened enormously. Let's take a look at the cotton prices based again on monthly prices and take a look at the inflation if I start to understand the problem associated with the weakness in the U.S. dollar. Then there it is, that once I have to convert it through another currency, then sure enough, it shows up significantly. And the red line is that euro adjustment, and that shows the relationship of cotton inflation to foreign currency exchange. We can see a similar effect in the Swiss franc. The wider spread between the Swiss franc version and the US dollar version again shows us that if somebody wanted to, they could actually sell the dollar, buy the Swiss franc, and then use the Swiss franc to buy cotton, and it would cost less if I have a stronger currency. Similar effect would show up if we did it with the US dollar and the Japanese yen. The other problem is that right now we're starting to get a problem in the amount of yield in the area harvested in foreign cotton. So as we take a look at the areas that are harvested based on thousands of hectares and based on the yield, we can see that recently the yields are starting to come down, and that is partially based on some of the climate disturbances that we're starting to see. Specifically, there's an increased amount of moisture over in China, the floods over in Pakistan, and the drought in the United States. And we'll visit the climate subject a little bit more closely. It's very influential regarding the overall story. Then taking a look at the expectations of what the USDA would like to see in their U.S. agricultural trade-weighted dollar, again connecting cotton inflation back to Forex, you can see that the long-term policy of the United States is to see the U.S. dollar come down somewhat in value through 2020. So take a look at that red line in the graph, and it explains that the geopolitical thinking in the United States is for the U.S. dollar to be weak enough in order to encourage a lot of exports of these key agricultural commodity crops, cotton being one of them. So the next time you look at QE2 and wonder why are we doing that, take a look at this graph and look at the long-term policy thinking here, excuse me, and you can see that there is the incentive to keep the dollar weak enough to stimulate sufficient exports of major agricultural crops. That is part of the long-term thinking in the United States. Taking a look at other major crops, looking at corn, barley, oats, wheat, rice, upland cotton. And upland cotton is the name that they give to the major type of cotton. About 90% of the biological type of cotton, which is planted, is a form of upland cotton. It's a certain species of cotton. My expertise on the biology of cotton as a crop from a horticultural perspective is very limited, so we're not even going to dare to go in that direction. But if we take a look at the long-term projections, take a look at corn up at the top as a percent of the total, and then take a look at cotton down at the bottom as a percentage of corn, and then as a percentage of the total, and that'll explain another reason why the inflationary story continues. Corn as a percentage of the total will continue to go from about 34 to about 36%. Cotton will go from about 3.7% to about 4.4%. As a percentage of corn, it will go up similarly in terms of percentage change, compound average rate over time, going from about 11% to about 12.3%. So it's very, very clear that the amount of acreage dedicated to corn, and then you can see wheat down in the middle, is also enormous. So cotton, relative to corn, relative to wheat, and relative to soybeans, the biofuels. And another thing about soybeans, we export an enormous amount of soybeans in raw and in derived forms to China, and they convert that into a lot of different things. Soybeans show up in many, many different derived forms. Gel caps, when we take our vitamins and supplements, frequently have some sort of a soybean derived component in it. So the influence of biofuels and then all the derived products coming from the different kinds of oils and gels resulting from these crops, it's all very geopolitical, very, very significant. It's impossible to disconnect one from the other. But you can see very clearly that the long-term trend is for cotton not to be competitive against the big biofuel grain crops and therefore the inflationary condition will persist. So let's stop from that perspective, which is a very broad 25,000 foot up in the air kind of perspective, and come down and get to what I think is really interesting. Just a quick note on my background. I worked in apparel manufacturing and activewear in the late 1990s in a company that was very sensitive to cotton inflation. Everything that we did was T-shirts and fleece wear. Therefore, the daily price of cotton was always a big deal, and that began when I started to look at cotton prices, and I've continued to be interested in cotton prices ever since that time. I do regard cotton prices as a major global geopolitical and economic indicator, very similar in my thinking to what others might see in crude oil. Let's take a look, all of that being said, to what's happening from certain companies in the industry to see what kind of an impact it's having. We noticed from the news release from Carter's, a leading apparel manufacturer and retailer of its own brands, primarily of children's clothing, in their quarterly report on Form 10Q for their quarter ended October 2nd, they said the following, quote, increased production costs may adversely affect our results. We anticipate increases in supply chain costs such as cotton, labor, and transportation costs. We are also anticipating appreciation in Asian currencies. All of these increases in currency appreciation would impact our cost of goods sold and inventory levels. We do not expect to be able to fully absorb these price increases by reducing our manufacturing or supply chain costs or by lowering our overall cost structure. And if we are unable to effectively raise prices, our profitability will be significantly impacted, end quote. You can see right there that a very good company that does what it does very well, that has very strong branding and a very strong position in the product, it has significant exposure to the risks that we just explained, which is the cotton inflation problem and the connection between foreign currency exchange and cotton and the rest of the crops. So you can see all of it pulling together right there in one place. So the weakness in the U.S. dollar, the outlook for continued weakness in the U.S. dollar, which results in relative strength in Asian currencies, all of that comes together to create risk to the cost of goods sold, which of course is the biggest component, and that in turn has a lot of impact on how the people at a company will think about fixed costs and the overall investment into infrastructure. It's very, very significant to future thinking about capital expenditures, product positioning, and what kind of products can be made in order to reduce these kinds of risk exposures. Another one, moving to the next slide, Primark is a unit of Associated British Foods. That's a big conglomerate out of the UK doing consumer foods and retailing. And in their annual report, which just came out recently, they also cited higher cotton prices. So let's read what they said, quote, profit was 35% ahead and operating margin improved substantially from 10.9% to 12.5%. This improvement was largely driven by economies of scale as revenues increased and by sterling's relative strength against the U.S. dollar in the first half, which benefited the cost of goods sourced in dollars and sold in the second half. However, we expect some of this margin improvement to be eroded in the coming financial year due to higher cotton prices, and I'll leave it right there. So ... quotation mark, you can see that here's another case where a company with a little bit of a different geographical dispersion is also exposed to the cotton price, and you can see them talking about Forex as well. Moving to another one, another UK company, New Look Retail Group, which is more of a fashion-forward, contemporary fashion specialty apparel retailer. Here's what they said in their news release, which also just came out a few days ago. Quote, looking ahead, the consumer spending environment remains difficult, in addition to which rising input costs and the impending increase in valuated taxes are likely to result in price rises in the new year. And I'm going to leave it at that. But you can see that they, too, are talking about rising input costs, and I believe that somewhere outside of this specific news release, they were cited as mentioning cotton as a part of those rising input costs. In much greater detail, we can see Hanes Brands, the U.S. maker of basic apparel products here in the United States, giving a lot of detail to the problem. So let's take a look at what they're saying here. I think that this is very, very significant and is worth looking at in the detail with that they gave it. They're seeing a sustained increase in various input costs such as cotton and oil-related materials, which will impact our results for the remainder of 2010 and in 2011. Rising demand for cotton resulting from the economic recovery, weather-related supply disruptions, and a sharp rise in the futures market for cotton have caused cotton prices to surge upward during 2010. After taking into consideration the cotton costs currently included in inventory, we expect the fourth quarter of 2010 should reflect an average cost of 79 cents per pound, a $26 million negative impact when compared to the fourth quarter of last year. We expect our cost of cotton to average 69 cents per pound for the full year of 2010 compared to 55 cents per pound for 2009, which will have a negative impact of approximately $33 million in 2010 compared to the full year of 2009. A substantial portion of our cotton costs are now fixed for the first 3 quarters of 2011, and we're gaining visibility for the rest of 2011. The first and second quarters of 2011 should reflect an average cost of 83 cents per pound, and the third quarter of 2011 should reflect an average cost of 88 cents per pound. We will lock in our cotton costs for the fourth quarter of 2011 later this year. Because of systemic cost inflation, particularly for cotton, energy, and labor, we have secured price increases to offset annualized input cost inflation, and we were working with our customers on joint efficiency initiatives. The timing and size of price increases will vary by product category and are expected to take place no later than February 2011, end quote. This is a fantastic disclosure and includes everything that we need to be focused on. In the last paragraph, it's right there, the things that are so meaningful to the practical side of the story. We have secured price increases, and now we have to raise the question, what kind of other adjustments might be requested by their retail partners such that the retailer doesn't have to incur any damage to gross profit. And we're working with our customers on joint efficiency initiatives, and there it is right there, which is the collaborative commerce aspect, which makes an enormous difference on this subject. So all of that is going to point back to what Hanes Brands is talking about right here. Let's take a look at some of the price volume impact very quickly. So when you go from what Hanes Brands said over there, this is a little bit of a technical discussion. I'm going to try to get through this quickly. You have price over there, which is your y-axis going up and down, and then Q is your quantity of units going horizontally on the x-axis. Your fixed costs will always be moving along that horizontal line. And then over time, as you have more quantity sold, more quantity produced and sold, then your variable costs are going to go up along with Q. So as prices fall, firms will typically try to increase the quantity that is sold. When the costs increase concurrent to weak sales and promotional pricing, variable expenses may have a greater negative impact on profits. Now, rising costs in the purchase order cycle, all of the conversation about cotton inflation, all of this has to do with the life cycle of the purchase order agreement and all of the stipulations in the purchase order agreement and how those will be influenced by changing cotton prices and by changing input costs and markup adjustments and markdown adjustments during the life cycle of the product in the purchase order agreement over time. So the cotton inflation tends to take this simple view of prices, quantity, and variable expenses, and it changes the frontiers up and down and left to right, and it does a little bit of damage, which you can see over here on the next slide, that as the costs continue to go up, it basically has an earlier impact in the purchase order agreement life cycle, changing the relationship between variable expenses, prices, quantity, and then the mechanics behind it, which have to do with markup and markdown, and the volumes that are associated with those schedules and the formulas, and it tends to disrupt the normal behavior of the purchase order agreement over time. So it's not a good situation, and it makes the relationship between the supplier and the retailer, in this case, rather complicated. Let's take it from the practical ground level and go back and take a look at some of the geopolitical issues. This is where we'll take a look at subsidies, China, and climate. In the United States, the largest subsidies go, of course, to the biggest crop producers, Texas, Georgia, Mississippi, California to a degree, Arkansas, Louisiana, the whole Delta area, and coastal South Carolina and North Carolina, especially eastern North Carolina is a big producer. You can see significant subsidies associated with Texas, which is by far the biggest producer here in the United States. Now, the drought in the United States is a big deal. Right now we have a La Nina condition, and that is warming up and drying out the south central United States and the southeastern United States. Let's take a look at what some of that might mean. The drought could expand into more of Tennessee, which is a pretty significant cotton producer, and into more of eastern and north and South Carolina, and it could go up into the really big crop-producing northwestern region of Texas. Now, if that occurs, and based on National Oceanographic Administration comments that we cite here, and we believe there's a 60% probability that this is going to occur in 2011, then some of the farmers in those states could be eligible for crop disaster relief. It really is possible. We are unfortunately looking at a pretty significant drought problem in south central and southeastern United States. This occurs at a time, very interesting, when state budgets, of course, are pretty bad, and the political pressure in the United States, and especially on Washington, D.C., to reduce spending, it's intensifying significantly, and it's really getting the support of the fiscal conservatives that were recently elected in big numbers into the House of Representatives in the midterm elections. So now we're starting to get the political connections between subsidies and climate and crops in the new midterm election change in the composition of the House of Representatives, and the Tea Party plays a significant role in all of that because the Tea Party is fiscal conservatives pushing to reduce spending. Very interesting timing, and unfortunately a bit inflationary. So if cotton crops could be eligible for relief, if the final yields from the harvested acres are low enough, that could trigger some eligibility. So it's kind of interesting that the drought could actually provide some relief to some of the farmers if the yields are below a certain formula, and it could provide them with some eligibility for relief. Now, until about 2011, subsidies and crop disaster relief were somewhat obscure subjects. Very interesting. It's been on my mind for a bit. All of a sudden on the TV business news in the last few days, I'm seeing all kinds of things pop up about an attack on subsidies. So it's starting to become not just an obscure subject. It may all of a sudden very quickly be exploding into more popular view. Moving on to slide number 28, I believe that's where we are, regarding the subsidy problem. I have provided some of the details from Brazil's World Trade Organization dispute. Basically speaking, they were successful. They are not happy with the way we subsidize cotton. It makes them less competitive in a crop that they would like to be more competitive with. And in order to keep them kind of happy, we send them about $147 million a year. And taking a look at the tables that we saw earlier, we can see that $147 million a year to one country in order to sustain our relationship, probably with China the most, is not really that expensive in terms of the overall geopolitical machinery that's involved. Very interesting to take a look at some of the populist things that are coming from other parts of politics here in the United States. Back in April of 2010, two Wisconsin congressmen are calling on the White House to resolve the U.S.-Brazil trade dispute by reforming U.S. agricultural subsidies, particularly cotton, instead of making annual payments to Brazil. So without reading the whole thing, and I do provide that to you as background reference, it's very interesting that all of a sudden things that have been coming from Democrats, and now you have the Tea Party influence, you have cotton as a major geopolitical crop, and you have people actually attacking the subsidy system, and it seems to be capable of getting a little bit more attention. Would that be good or bad for prices? Generally speaking, any diminishment of subsidies would probably make it a little bit more difficult for China to obtain the amount of cotton in the volume that they need to produce the output that they need, which in turn creates surpluses in China that they use partially to purchase U.S. Treasury debt. And then when we send a check to Brazil for $147 million, where did the money come from? From the issuance of U.S. Treasury debt, which is how we fund ourselves. And that, in turn, is partially funded by the trade surpluses with our trading partners like China and Japan, which buy big volumes of U.S. Treasury debt. Therefore, the connections between cotton and very unpleasant geopolitical monetary realities is a very short, linear circle. Well, actually, it's a linear in concept and circular in shape. Anyway, without subsidies, it would not pay for Americans to produce much cotton. With them, the U.S. is the world's largest cotton exporter. Some 25,000 rich American cotton farmers divide $3 to $4 billion in subsidies among themselves, with most of the money going to a small fraction of the recipients. According to Joseph Stiglitz, the Nobel laureate in economics in 2001, in an editorial that he wrote in The Guardian, a UK publication back in October of 2006. So there it is right there. The connection between the inflation that we're seeing in cotton and subsidies and crop production, it's extremely sensitive, complicated stuff. Now, China is very, very influential over here, so let's talk about it very quickly. The amount of volume that goes on over there, it basically pulls up the prices globally. So China recently, they've been paying about $2.20 a pound for cotton. The volume of cotton exports to China influences global prices. So in simple supply and demand language, if the biggest customer is going to pay, a certain amount, and they're the biggest buyer in the market by far, it's going to influence the prices in the rest of the market. The cost of shipping cotton to China also is influential. It costs about 15 cents a pound to ship the cotton over to China, so therefore it makes sense to produce more cotton for China in order to manage the profit margin. So if China pays, let's say, $2 and it costs 15 cents to ship, then if the local cost is $1.40, you still got some margin there, so you can figure out the rest of the story. So as long as cotton prices go up and it doesn't cost that much to ship, assuming that crude oil prices were not to explode way out of control, then the mechanism remains in place for the cotton relationship between the United States and China. Taking a look at the cotton-producing areas of the United States in order to explain the susceptibility of these areas to climate disturbance, let's take a look. The dark orange areas in northwestern Texas, that's the biggest cotton-producing area. Lubbock, Texas is a cotton capital in the United States. And then you can see the delta areas and then up coastal Carolinas. These are all major producing areas. So now let's see if we can figure out where's the drought. So the drought right now, based on the latest from the drought group over there at NOAA, the National Oceanic and Atmospheric Administration, it looks like the northwestern portion of Texas is being spared the worst of the drought at this time. The rest of the Delta region is badly impacted. Coastal North Carolina so far is not that badly impacted. Let's take a look at a few other understandings of the U.S. winter outlook for dry and wet weather. The outlook is for dryness to continue in most of Texas and going into some of the coastal area of South Carolina. You can see the dryness definitely affecting the crop-producing areas. Some of it is starting to expect to impact some of the northwestern Texas area, and some dryness coming into the coastal eastern North Carolina producing area as well. All of that is detrimental to crop yield. Taking a look at temperatures, you can see that significant warm weather associated, of course, with drought is emanating and expanding out of south central United States and centralized right there in Texas. All of that is bad for crop yield for the amount of acres that are harvested and planted. So the outlook for crop production in the United States is not that favorable, therefore it is inflationary. Taking a look at their understanding of the La Nina effect, looking at their 3-month outlook, and we're getting, this is a product that they produced on October 21st, and this would be valid for November, December, and January. You can see significant dryness, very likely hitting further into northwestern Texas and significantly into the eastern Carolinas. So the cotton-producing regions in the United States are at risk. The amount of cotton acres may increase in key regions, especially Texas, but the yield from the higher acreage is very likely going to disappoint. The climate conditions in most of the cotton production ring from West Texas to the coastal Carolinas are unfortunately facing continued drought conditions, inflationary. The Climate Prediction Center warns that the cause of the drought, the La Nina, which is a cooler than normal Pacific Ocean surface temperature, should persist until at least spring 2011. They have mentioned in some of their commentaries that there is the risk that it could occur all the way through summer 2011. I would tend to bet that I think it will, and that's based on my experience with drought in the southeastern United States, where I have lived since 1991. So all of this indicates that continued strong demand globally, concurrent to the expected shortfall in the quality of the crops that are yielded from the acres planted in the U.S., should continue to fuel occasional waves of cotton price inflation. The competition globally to plant the biofuels suggests that the climate-related crop situation in the U.S. may not be resolved through increased cotton plantings in other places outside of the United States. Our volume of cotton production, subsidies, and exports makes it a little bit difficult for someone else to pick up the slack. In India, very clearly because of the workers being pretty, open about protesting what India might want to do, they're not going to let it happen. Therefore, the outlook for supply is constrained, and therefore the inflation story remains in place. So what should we all do about it? And this is where hedging starts to come into and then leaves the picture pretty quickly. In a nutshell, without reading all of this, what we find is that the put options and call options based off of the exchange-traded cotton futures is a typical product that can be used primarily for those at the crop, fiber, and mill level, and it is much more difficult to really use those effectively once you get to the supplier, retail, final goods level of the industry. That's our opinion on the subject, that yes, it can be done to a degree, but primarily those benefit those who are fiber manufacturers. The Intercontinental Exchange, the ICE, provides a market for the put and the call options on the cotton futures. The futures are an exchange-traded security. The spot market is a cash basis market. The forward is a different gate for a cash basis transaction. Manufacturers and their suppliers, typically fabric mills in Asia, they might use some of the exchange-traded options to reduce the cost of buying the cotton when the prices are rising. It's not necessarily a simple thing to do even for them. Most of the remedies, in our opinion, are most effective when the prices are falling. The cost of purchasing and selling options combinations may also provide losses, which have a little bit of tax deduction value. So sometimes, as in the case of what we saw with the disclosure by Hanes Brands, you do get a little bit of a tax deduction associated with that event. In a nutshell, some of the producers, they may reduce input costs to a degree, but there's a cost of doing that because they have to pay for the options, and they face continued margin and volume pressures from the retailers on the other side of the statement of operations. The retailers have a markup system in the United States. They are going to try to preserve that. They're going to be very careful about competition. So the intermediaries, the producers of cotton-based apparel products selling to retailers in the United States, and then of course the UK, we saw a similar story from the retailers, Primark and New Look over there. The sensitivity on cost of goods sold and on markup is pretty significant, so it is a very, very difficult situation. Collaboration with international cotton fiber mills and fabric mills, to a degree that can help the mills to hedge against the rising costs. You have to kind of try to understand how long any of the price corrections take place. So the price correction in cotton that is taking place right now over the last few days since China announced that they would be tightening up things a little bit, you have to be able to figure out how long does that last, where does it bottom out, what is the nature of the volatility of the change in price, when does it bottom and when does it start going up. If you can model that, then you can be very effective in using call and put options. So it starts to turn itself back to the modeling of the expected troughs and peaks in the volatility of the price behavior for each major cotton contract. It's not an easy thing to do. The other considerations, the price remedies that are available to the cotton farmers and the sellers in a rising price market, those are generally really not, a good fit for the types of solutions and remedies that would work for the resellers, the intermediaries, and manufacturers. For example, Hanes brands or Carter's. The intermediaries, they face the most pressure at this time. So knowing how long the corrections take place and understanding some of the other corrections in the cotton prices, all of those come together to explain what you need to do. In the end, we come up with 5 very simple tactics, and it all points back to supply chain collaboration, especially between brands and retailers. We would not say that the use of exchange-traded options is an easy and practical solution all the time during a period of such severe volatility, and especially when prices are rising in this way with this kind of an input cost, and there are other input costs that are going up as well. Therefore, the best solution is to collaborate across a wide range of expenses. That was, I think, explicitly explained in that last paragraph in that disclosure by Hanes Brands when they said that about trying to team up with their partners on a greater number of efficiencies. So when you see that language about efficiencies, it's a conversation about variable expenses and different kinds of shared costs and shared expenses. The purchase order agreement is the epicenter of that, and that's where they can work out all those details and see if they can team up in order to smooth out some of the volatility in the variable expenses especially. So number one, you want to collaborate with your partners on a wider range of expenses. The best solutions for suppliers and retailers, they very likely come from improved collaboration regarding many different expense categories, including information-related issues, and then operational and then price and volume-related issues as well. By information-related issues, I am referring to the quality of the IT and the quality of data sharing where it is intellectually possible to do so. Number two, you have to worry about your fabric suppliers globally, so you need to have sufficient visibility into global suppliers of fabrics and fibers, whether they're capable of hedging, whether they're good at it, whether they've been successful at it, because that'll influence their exposure to the higher input costs, and then how much you're going to be requested to pay to them for, their production of the fiber and the fabric back to you. You have to innovate. Number three, even slightly product innovation is part of the solution. So at the same time, the consumers, especially here in the United States and Europe, they'll typically pay a little bit more for products where they perceive a little bit of a better value, especially if the product has other value-added features other than its basic fabric component. An interesting angle on that would always be what Walmart does in its effort on organic cotton. There might be a certain constituency over there that is loyal to the Walmart apparel product because it says that it's organic cotton. That's one example. Point number 4, reduce other costs using analytics to discover those other costs that might be reduced without compromising quality, without compromising on product innovation, and without endangering your market share in a product. And then number 5, which unfortunately is the most esoteric and the most difficult thing to do, is to build a model, to build a risk model. The winners in this situation will have the resources and then they'll have the time internally or through consultants to have models that measure all of these different influences and all of these different multiple variables over time. It's a very complex situation. You've got diesel fuel, you've got the cost of labor, you've got factory labor availability in China, you've got the basic input cost of cotton fibers, you've got how much China pays for cotton fibers. So those are just some of the variables. Then you've got the things associated with duties and the certain surcharges that China has to pay to export to the United States. All of these have to go into a relatively sophisticated risk model. It's not an easy thing to do, but in the end, the winners will be doing that as much as they possibly can, and they'll be building it and monitoring all these different variables constantly, even if the model is not capable of scoring and weighting those in a simple way. It's still going to be capable of tracking the trends on every one of those inputs over time. I'm going to conclude all of those many comments about this vast subject. The subject of cotton is an enormous subject. We have made no effort to understand the biology of the crops, which is another subject unto itself. We have hoped that this would address the basic question of whether cotton prices would be going up or down and why. I believe that we have answered that, and that we have emphasized in the end that supply chain collaboration for resellers, retailers, and brands is the best solution, that exchange-traded options are going to be much more difficult to use in this situation. So I'm going to turn it back to Alan, and I look forward to hearing from you in the next few minutes with your questions.
Richard, thank you so very much for that. I'm just astonished with, as we always are, with the depth and breadth of your understanding and the amount of information you can bring to bear. We have some great questions coming in, and we encourage you to continue to bring them in. And as soon as we get past our latest little technical hiccup, we'll continue on. But while we're working on that, I think one of the important points to make is that this crisis has really been talked about, as Richard says, for quite a long time. It's dramatically more complex than just simply a supply and demand issue. And it comes down to issues of, for you, risk mitigation and being able to plan and respond to that risk. So one of the things that I think is important to keep in mind is that at a practical level, it comes down to, in many ways, what systems are necessary and possible to help support many of the remedies that he has suggested, and really how to go about that process. From a practical impact perspective, what does this mean for those of you on the call? And I think some of this is reflected in the wave of questions that are coming in, and please do keep them coming in. We'll get to as many of them later as we can. One, most important, is that the volatility of any material, today it's cotton, it may be any number of different things, later will absolutely have an influence on design, whether you're a brand manufacturer or if you're a retailer with private brands. Factory capacity is no longer a given, and it changes over very short periods of time. And given the fact that you have to react more quickly to changes upstream, you may have to change transportation more frequently, and that impacts cost as much as any other factor does. And finally, the point to make is that relationships between vendors, suppliers, and across your supply chain is absolutely critical. It's an imperative. It's no longer a nice to have. I mean, the fact is everyone in the design to delivery process is going to be constrained with material and labor shortages. The practicality is that you will have to work within a smaller sandbox or be more creative within that sandbox to be successful. So managing changes to schedules, purchase orders, coordinating adjustments, let alone understanding the impacts, per some of Richard's discussion, will be absolutely problematic, impossible at worst. And I think there's going to be much fallout in the market, and certainly recent data suggests that. So the question on the table is, how do we cope with all this uncertainty? Well, as any of our customers on this webinar know, a lot of it is about having very good processes and, equally important, systems that enable and support those processes. And really that's where TradeStone and its merchandise lifecycle management software comes in. And I promise that we'll go through this quickly and get to your questions. But I think it's important to understand that there is an underpinning that may help to facilitate your ability to manage risk and improve your productivity and margins. We start with retail domain expertise. We apply that domain expertise to a very sophisticated buying engine that supports domestic and global sourcing. We apply best practices that have been derived from our own experiences and our customers. And the result is that you have the ability to create in your supply chain, in your design delivery process, a unified environment, one that ties together domestic and global sourcing, one that allows you to create a single version of the truth, one that brings your private and branded merchandise planning together into one place. Since decision making is critical, since reaction time is critical, it's absolutely imperative that you're working from the same book and people are interacting. And that brings us to a really key aspect here, the collaboration upstream, downstream, and within your organization is absolutely imperative. It's absolutely critical for success at times where decisions in a day are the difference between success and failure. Bridging the art and science sides, your design side, and your production planning and material management side is certainly one aspect of this, but it's critically important, and I know I keep using critical and imperative in a sentence, but I think that it's warranted here. And as some of the questions that I see coming in speak to, it's about understanding one another's needs. It's about interacting up and down the supply chain and finding a way to develop a middle ground that everyone can live with in less than normal times. The result is that you create a transformational environment, one that lets you plan in advance, one that lets you anticipate, not one that requires you to spend all of your time reacting in the most tactical of ways, but rather gives you the chance to start thinking more globally and start thinking further about how you can expand even in the face of this. I'm struck by Urban Outfitters' recent earnings call. I think it was yesterday or 2 days ago, and one of the lines by the CEO that I recall hearing and just seeing this morning in the transcript was that he talked about the various crises that are besetting retail globally, and he said that because of the system initiatives, the strategic initiatives that they've engaged in, and I'll just add, including TradeStone, they are very well poised to take advantage of this opportunity, and they definitely see this as an opportunity. And for those of you who follow Urban Outfitters, they are certainly a success model for many in the market. So without going into technical details, I will save that for a follow-on event and for more information that we'll be happy to provide to you. We're talking about a transformational footprint. We're talking about one that allows you to start with a unified view of the world that lets you go from the design of your goods, from inspiration, through the extraordinarily complex processes of sourcing these days and interacting with suppliers, for managing those relationships, for managing your orders, your purchase orders, your change requests, your logistics issues, all together in a single environment, and ultimately being able to get the right product on the shelf at a price your customers will buy at a margin that you and everyone in your supply chain is comfortable with. If you'd like to learn more about any of what we're talking about today at TradeStone, and especially about our products and how we enable retailers and manufacturers to be able to be more agile in this environment, I offer you both info at TradeStoneSoftware.com. Drop us a note. We'll have someone get back to you and discuss your specific issues. Also, I encourage you to go to our website, TradeStoneSoftware.com, look under our resources section. And I also want to direct you to our CEO's blog, Sue Welsh's blog. That's reachable from our homepage. Just click on the blog button, and that will take you to her blog. This month in particular, she talked specifically about the cotton crisis and what TradeStone did from a systemic perspective to try to help and sort that out. I know you'll find it a useful read. So with that, and being conscious of time and all of the questions that are coming in, I want to open things up for questions. And Richard, I'll ask you to respond to some of these. It's really quite a long list, and we've been busy consolidating them. So a number of the questions revolve, Richard, around what, if anything, world governments are doing to stop speculators from increasing prices or having an adverse effect on an already difficult situation.
Oh, that's a great question. I like that question. The question started to get a lot of basis, if you will, when crude oil prices went up spectacularly in 2007, and then there was the question at that time about speculators. The way that you drive up a commodity price in order to make money on it by speculating, you don't want to buy a contract for the physical delivery of the commodity. Obviously, you don't want the stuff. You just want to be able to sell some sort of a contract at a lot more money than you paid for it. Okay? So the way you do that is actually through foreign currency, through Forex. So back in 2007, the strategy probably was through the Forex market to sell the dollar, which of course, you know, there were fundamental reasons why you would sell the dollar, because we were selling too much debt and the fundamentals in the United States were not the greatest. And you would sell the dollar and buy the euro. And then when you looked at that effect, you could see that the commodity price would go up as the euro would go up against the dollar. It's very difficult to control that. The Forex market is by many multiples greater than the equity and corporate bond markets put together. It is much less regulated. There is some talk sometimes about regulating it. I would be concerned about what that might do to global liquidity if it were regulated more than it is right now. So the answer to the question is, number one, the speculation occurs primarily through Forex. Number two, it does not attempt to go after the physical delivery of any commodity. Number three, there is a monetary connection back to these very unusually large issuances of sovereign debt. I don't think that we would have the same conditions. Obviously, if you go back over time, every 20, 30, 50, 75 years, there's always going to be some sort of a train wreck out there. So right now it's some of this stuff. Back in the 70s it was something else, and back in the 1920s and 30s it was something else. There's always something. All of that kind of leads to the subject of the amount of sovereign debt that is issued by the UK, by Japan, by the United States, by really all of the mature, developed industrial economies. Germany is not like that. They're not into that. They like to be a lot more fiscally responsible. But generally speaking, if you kind of look at a lot of the mature, developed economies, they're all bloated debt issuers. And that requires conversion of currency in local markets, which changes the amount of reserves and then changes the amount of trading in currencies. So as long as the United States, here's the nutshell on the speculation question, as long as the United States remains as big an issuer of Treasury debt as we are, then some of this speculative environment will be encouraged by the monetary opportunities that are created by the excess amount of Treasury debt that is purchased and converted globally. It's an esoteric answer to a complex question, but I think those 4 points comprehensively answer the question about speculation.
Richard, thanks so much for that. As always, a comprehensive answer. There are a series of questions that all revolve around, I guess with tongue-in-cheek, I'd say that not everybody seems to be ready to be playing nice just yet in the supply chain. There's questions about retailers being willing to offer long-range commitments but not providing any kind of relief, even as there were unexpected large rises in raw materials. There are questions about fabric manufacturers nullifying current orders in hand and not taking orders, which is causing panic in some quarters. And there are a number of questions that all revolve around that. So I guess in your evaluation of this, what is your sense of, you know, where people really need to be paying attention, where they can be being a bit more constructive, and whether you're seeing some trends to start rationalizing the supply chain, or is it going to continue to be chaotic?
Yeah, I think that the question, let's take it apart from the purchase order agreement and the accounting angle. Okay, so if I am the producer of a brand and I have retailer partners, I've got a purchase order agreement and there's a whole bunch of different things in there. I have found that I really need to raise my prices on the inventory sold, and I'm asking for 2%. If my retailer partner in the purchase order agreement agrees to pay 2% more in cost of goods sold, inventory line item, price paid for inventory, that they're going to pay me that much more, you know what? They're probably going to be looking for something in some other expenses to offset the 2%. Because then that faces them with the conundrum of having to mark up their products from those specific things that I'm shipping to them. Let's say denim jeans. Okay, denim jeans, I need to get 2% more on my latest shipments of inventory to the retailer, and the retailer says yes to the inventory price paid in cost of goods sold. Let me tell you something, I can guarantee you that I'm going to wind up eating the 2% somewhere else. So it's at that point that you have to be strategically capable of being such a good trading partner with that retailer that it is not damaging to your business. There are markup percentages that the retailer can do, and then there are other variable expenses that if you're capable of those efficiencies, which is what Hanes Brands was talking about in that news release comment, and that's why I liked it so much, because it spoke right to the heart and soul of the purchase order agreement and to really to merchandising life cycle management, if you don't mind my doing an infomercial for MLM for a second. But it's the ability of the supplier to collaborate with the retailer efficiently in terms of IT and efficiently in terms of the quality of the brand, that it will sell through in sufficient volume during the season when it is supposed to, at the markup that's agreed upon, such that there's not more of a problem. Because if they want to raise the price slightly, the consumer may not care if it's a brand that they really want and it's a leading product. The very slight increase in the price probably is not that big of a deal. It's everything else that starts to matter when it doesn't work out as expected. And it's at that point that you have to really be a high-quality partner on many different levels in order to avoid some real damage. Now, the situation regarding brands that are suppliers of product to retailers, it's not consistent across the board. Those that typically are very, very big markup products that have a little bit more leverage in their product categories and that square footage in the department store. For example, Ralph Lauren Corporation, they're not citing a lot of problem here, and then those in the moderate market are facing much more pressure. Well, naturally, they also are subject to a different type of reseller environment, which requests a lot more concessions from its vendors to begin with. If you were to start to look at the influence of higher input costs on something like Coach, on accessories, or in Ralph Lauren Corporation on apparel and accessories and fragrances, the impact is not as severe. And then if you look at a reseller channel like Dillard's, for example, in the United States, they really don't do a widespread promotional pricing model to begin with. So when they do their markdowns, it's a limited offering for a limited amount of time, and if you're not the right customer and you're not there and you're really not hooked up with them and you're not in tune, you're not going to really know that it ever took place. So for those that are high markup in full selling situations, the impact is minimal, and for the others, the impact is pretty significant. I'm going to turn it back to you, Alan.
Thanks, Richard. Our next set of questions all fall around the category of retailers, in this case, either vertically integrating, in one case, in one question, all the way up to the farm. And I think what they're doing by extension is sort of just taking positions in the crops themselves, but I think the question is still a good one. Or doing more direct sourcing and cutting out the various intermediary points that they may have worked with in the past. Are you seeing trends in that direction?
The trend has been in that direction significantly for quite some time, and continues to be for the major retailers in Europe and especially in the United States to be more vertically, strategically positioned so that they have more control over supply chain. They are taking possession of goods freight on board at the ports in Asia, all in order to have more control over quantity coming in, more control over proprietary information technology so that they don't have to try to collaborate with another party's information system, which might be a totally different type of file format and creates additional IT-related labor and hourly costs. The general trend is towards that kind of vertical integration. At that point, in a period of rising inflation, just as it is during a period of severe deflation, but especially during a period of rising inflation, the biggest players start to do better and start to become disproportionately powerful and can do some real damage in terms of market share in specific product categories. It's not a pleasant situation because of their capabilities, the scale of their purchases, the size of the volume of the purchase order agreements drive down the input costs per unit produced and sold, the capabilities on logistics, again, and the sophistication from really big retailers on mitigating costs and using hedging instruments to drive down the cost of diesel fuel. It starts to get to the point where it's so competitive that smaller firms, some of which can be very valuable and are well known to all of us, can really have a tough time. So it's not a pretty picture.
Do you see this as severe as the disintermediation that took place in the airline industry with travel agents and other sources of ticketing and layers, or do you see that this, because it's got such a big mix of large and small players, that it's going to have a different play out?
The big mix of different players. The end of your suggestions and the way you posed it, Alan, excuse me, I don't think that it turns into this severe verticality that we understand from the airline industry. I think it's better understood from a more difficult situation, yes. Some weeding out of certain players, more mergers in the industry, but I don't see it turning into the very unusual situation that prevails in the airline industry. I don't see that occurring.
Okay. One last question in that regard, and then I'll ask you the final question for the session. That is, do you see that this crisis and others that may be coming along, labor certainly another one that we'll be talking about in a few weeks, do you see that as having a direct impact on mergers, acquisitions, and failures in the retail marketplace, or are there so many other factors involved that this is just one more log on the fire?
The capital markets, especially on the debt side, are very liquid. The volatility in the debt marketplace is what you need to look at to understand whether mergers and acquisitions would be favorable if the environment is favorable. The stock market is a secondary indicator here. The volatility in the stock market is not the number one thing. The primary thing is the liquidity and the stability of the debt market, which is in very, very good shape. Because of that, and the stock market always has a little bit more of a volatility than the debt market would unless there's a systemic problem in the debt market, which occurred in July of 2007 and then started to subside in 2009, which was all associated with the credit crisis. The debt market is the credit market. The equity market is a little bit of a different animal. The IPO market is one thing, but the key to understanding whether M&A activity, mergers and acquisitions, would be encouraged is the quality of the liquidity and the cost of capital in the debt market. And right now that condition is very favorable. Therefore, the conditions that we're talking about competitively in the supply chain of brands to consumers in the consumer goods universe is probably a fertile area for continued interest of M&A in order to reduce total costs, in order to create greater efficiencies of capital expenditures, in order to enhance earnings in the future against more controllable selling, general, administrative expenses, fixed costs. Basically, the M&A in this environment would be probably in many cases something favorable. As the scale of the purchase goes up, the cost of cotton per unit produced goes down slightly, unless the inflation is so impossible that it offsets that over time as well. And then the amount of quantity that would be requested by the retailer would never be enough to offset the problem of cost associated with the input inflation. So that being said, I think that the environment for M&A in consumer goods right now is favorable, and it can be very helpful to tackle what looks like a longer-term phase of inflation. And then you've got more monetary stuff unfolding over the next couple of years, all of which points to inflation. You do have deflation in real estate assets in the United States and in the UK. Ireland's got some of it. Spain's got a lot of it. Japan's got, certain residual problems from real estate deflation that they've been living with for years, and that's why people are afraid that we're going to have the same thing here in the United States with just, endless years and years and years of deflation. Deflation and inflation always coexist. You can put it on your bumper sticker on your car, which I can make a fortune creating an inflation-deflation coexist bumper sticker, Alan. And what we'll have over here is probably more concerns about inflation with the monetary forces coming together in a couple of years to encourage additional rounds of inflation.
Great. Thank you. I just, to the audience, we have, before I get to our last question of the day, we've had a number of questions asking about China and the labor market and whether or not that may have an impact on manufacturing, relative manufacturing strength and favorability. And to those, I want to say that our next webinar is specifically on the labor market and in particular China and other higher and lower cost areas. So I'll direct you to that and not spoil the surprise. Now the final question, and that webinar, by the way, is November 30th. I want to come to our last question, and Richard, you'll smile when I ask this. Probably half the people on this call today asked it in one form or another, and I'll sum it up and say, what is your perspective on where you think the price of cotton will settle, and in what time frame do you think that will happen?
There it is. There's the question. Right now we're at about $1.35 a pound based on the India protests and the likelihood that the government there would give in based on the climate disturbances and the drought. I would tend to think that we're only about 3 to 5 weeks away from cotton moving back closer to about $1.45 to $1.50. What I think occurs in certain currency pairs, and in Forex, everything is based on a pair of two currencies, one sold to buy the other, or you can have the inverse, for example, the U.S. dollar divided by the Japanese yen, or the inverse, the Japanese yen divided by the U.S. dollar, one sold to buy the other, so you get one number. What I would tend to say is that they tend to reset themselves at a new price level, and then they oscillate from there. The only thing that will knock it off course is something severe, an external catalyst of a systemic nature like what occurred with the global credit crisis in 2007 and 2008. Because I don't see that taking place, anything of that systemic nature, I tend to believe that cotton is repricing itself somewhere in the $1.35 to $1.50 area, and I think it's going to be difficult for prices to go below that. So I would be comfortable thinking that our price level is going to resume towards about $1.40, $1.45 within a few weeks, and then closer towards $1.50, and then hanging out there more persistently after a couple of months. The price oscillations from there will depend on the news regarding crop yields next year, La Nina, India, and any continued pressure on subsidies in the United States if it really starts to continue to gather some strength, which is going to be very difficult to do anything about it. But even if it's just jawboning and talking, and the fear that the subsidies could change one day in the future could change the price of exchange-traded cotton futures even 3 months from now.
Great, Richard. Thank you so much for that. And with that, let me thank you all once again for joining this extended webinar. We hope you found it valuable. I know I certainly learn a lot every time I listen to Richard, and I'm sure you feel the same way. One quick note, I want to point you to our website, www.tradestonesoftware.com. If you go to the events page, you'll find registrations for the webinars that we've referenced here in the conversation. Mr. Hastings will also be presenting on the labor market, so I think you'll find that equally fascinating and filled with fact. And then finally, we encourage you to contact us for more information, and we'll have the recording of this webinar available in the next few days. Thank you again for your participation. Hope you enjoyed it, and we look forward to having you on another one of our events soon. Take care.